Also due in large part to strong operational performance that came through in the second half, and a great effort and commitment and dedication from all of our Sasol people across the world. It was definitely not just crude oil prices, which, as you say, that was up 17% on average this year, and a weaker rand down 11% average. So that obviously helps us as you bring your profits back to South Africa. But no, it was other things definitely, and very proud of our people out there.
And if you were to identify the major kicker in this set of results for the full year, what would you identify that as?
I'm sorry, the major
booster to these results.
Well, I think having Synfuels come back in the second half. In the first half, we had major industrial action in July of 2011. Then we had plant instabilities at Synfuels and a fire on a conveyor, which is on a coal conveyor feeding Synfuels. So we had a very difficult time in the first half, and volumes were definitely down. But we've been able to, in the second half, really turn it on. In fact, the run rate in the second half at Synfuels is the best it's been in 5 years. And that's due in large part to a lot of the new equipment we're putting in, a lot of jobs being created out there with our Secunda Growth Program, installing new equipment that's really helped our plant run hard in the second half, and that's a large part of it.
Yeah, so let's talk about that second half performance in terms of numbers. Compare it, if you can, against the previous second half of the prior year.
We did 7.2 million tons across the year, up 1.1%. So really, I would say that volumes were in line, if you will, with the previous year. That's probably the best way to look at it. But again, Synfuels up 1.1% is, after all those challenges, is really why we're so excited about what they're doing out there. And what we're really seeing is that we're focusing on getting back to basics on reliability and operability and maintainability of that plant. We've got an excellent managing director out there, running things, and we can really see that improvement, and we expect to see it going forward.
Let's talk about the sustainability of these earnings. I mean, record year in your first full year in charge. I know a year is a long time in this environment that we are in. When you look out a year out, what do you see in terms of earnings growth going forward?
Yeah, we, a large part of it is going to, it's going to be based on that oil price and that rand. And so our projections are fairly conservative, but what we see is possibly a couple of years of similar earnings, slightly up in the next couple of years. And then we'll start seeing our growth projects, our big growth projects that really can contribute more volume. And if you think about it, on our liquid fuels volumes right now, by the end of the decade, if we build our projects that we're planning right now, we could be up 93% above where we are now. So 193% increase over where we are right now by the end of the decade. So that's exciting, and that'll obviously drive increased earnings.
Absolutely. What about that oil price? I mean, we get all sorts of numbers. Yeah. Where do you see it going? And if you can just give me some numbers, please.
Yeah, well, it's, we have investment numbers that we use to stress test our investments, and of course that's not something that we put out there because it's competitive information. But sure. We think about $100 oil price and an $8 or 8 rand exchange rate to the US dollar, and that's where we're at. And then of course we move up and down from that depending on what we're looking at.
Let's talk about hedging. Are you looking to hedge, and what percentage are you looking to hedge going forward?
Yeah, in the past we have hedged. Usually take a look at about 30% of our Synfuels volumes and 30% of our oil out of Gabon in Africa. But right now, that's a risk mitigation. Clearly that's a risk mitigation tool that you can use. We use currency hedges all the time. In fact, in Canada right now, we hedge against our expenditures on the Canadian operations. But from an oil hedging perspective right now, with our deleveraged balance sheet, it's really not necessary to do that right now. We watch it. We watch the collar and cap zero cost range on the oil hedges, and keep in close contact with my CFO and Christine Ramon, and we keep a close eye on. But right for the foreseeable future, I think we're okay with with where our balance sheet sets up right now.
Yeah.